The cost of borrowing dollars is going to continue to increase, and that's bad news for Asian stocks. Hong Kong's index fell 2% Wednesday, and Europe is also set to follow in a few hours. The rout in equities came after Federal Reserve Chairman Jerome Powell told U.S. Congress that interest rate hikes will continue. And that's after a recent report showing prices for consumers started rising again. That dashed hopes the U.S. economy could avoid a recession while still taming inflation. Crucial bond market indicators are also flashing red, signaling that a contraction may now be inevitable. For more on this now, let's go to Naeem Aslam, a capital markets CIO in London. Naeem, thank you very much for being with us today. So as we saw, we now have a deeply inverted yield curve because we took a look at the 5-year Treasury bond and the 10-year Treasury bond, and that shows that it's inverted. That's normally, right, a harbinger of recession. But other data are not really showing the same thing. They're not really pointing necessarily at recession in the US. What's your expectations now?
Sure. Thanks for having me. Look, I think the Federal Reserve keeps changing the goalpost with respect to their monetary policy expectation, and that is the reaction that we've experienced in the markets. And as you rightfully highlighted right at the top of this particular program, the borrowing cost is going to be soaring once again, because when you look at the financier or any company which is providing finance, they were looking at the Fed's terminal rate in around 5.5%, in fact. Then it went to 5.25, then 5.50. Now the expectations are that, okay, it is actually going to be above 5.50, perhaps 5.65. The Fed's funds future rate, they've already started to price in another 50 basis point interest rate hike. This used to be like 25 basis point was what was considered and factored into the market. So yes, now I think the challenges are going to be quite immense, because especially with the borrowing cost. But if you look at the commentary and the Federal Reserve's chairman's testimony yesterday, and who will be also testifying today, his stance is very, very clear. We do not see major signs of any potential or even potential threat of recession. Data is still very much robust in their opinion. Well, I think traders and investors need to think about everything with a bit of a pinch of salt and don't be carried away what the Federal Reserve said yesterday, because this particular week is highly important with the US NFP data coming on Friday.
Interesting, Naeem. So for now, not a real threat of recession, at least in the US. But we are seeing this morning consumer cyclicals, healthcare, basic material stocks leading losses, right, at least in Asia, in Asian markets. And I really want to ask you, can you help us understand, I mean, higher rates, what are they going to impact the most? What sort of sectors are going to be most impacted?
Discretionary income. That is the key word over here. With higher interest rate, you are going to be paying higher mortgage, right? For example, in London, 4 million mortgages are due to be renewed. So that means if anyone who was sitting on a 700, which in London is not a case, because in London it's at least £2,000 that you were talking about, so they'd be pushed to 4,000, and that is going to be, so that means that less spending, less money or disposable income at their disposal to spend that, and that's going to hit every single particular sector, which we have been talking about for quite some time. But with interest rate, and then especially the fact that we don't see the way the Federal Reserve is really drawing the line and keep changing the goalpost, it's going to create more concerns among investors and traders, and especially among institutions who are going to say that, okay, you know what, we are happy to give you these amount of funds at a 5% or a 6%. Now today, must be sitting and scratching their heads. Okay, the Fed has done that. What's the other central banks are going to do? Pretty much they follow each other, and then the action is very much in tandem.
Right, so very, very bad news for mortgage holders there. Naeem Aslam, thank you very much. And now let's go to other top stories from around the world. Japan posted a record current account deficit of $14.4 billion in January. The high deficit is due to rising energy costs, including coal, liquefied natural gas and crude oil, which the country is heavily reliant upon. A weak yen also made import costs more expensive. The figure is the largest since comparable data became available in 1985. Russia is considering challenging the US nominee to head the World Bank. Roman Marshevin, the World Bank executive director who represents Russia and Syria, says Moscow is consulting with its allies about possible candidates, including Russian financiers and foreign economists. Last month, US President Joe Biden nominated former MasterCard boss Ajay Banga to become president of the World Bank. And Cathay Pacific Airways has reported its first annual operating profit since 2019 as Hong Kong reopened for quarantine-free travel. Operating profit in 2022 came in at $452 million, beating analyst expectations. But the Hong Kong carrier saw a net loss of $828 million last year due to the poor results of associated companies, including Air China. And that is all from business for now.
All right, so if the Fed's moves are designed to slow inflation, right, then how are they such bad news? Wouldn't it be worse to let inflation?
Absolutely, absolutely. And that's what some analysts are saying. But obviously, it's not easy for individuals as well. Obviously, you need mortgages for companies to also borrow money to borrow any kind of money, because the cost of money is going up at the same time.
Yeah.
So
Lesser of two evils, perhaps.
Exactly, possibly.
All right, thanks, Ludovica.